5 years. I'm also the host of Real Estate 360. That's a radio show carried on the Wall Street Radio Network in San Francisco. I am on Thursdays from 2 to 3 o'clock. If you're in the Bay Area, you can listen on AM 1220, or if you want to listen to it online, you can listen to it live online every Thursday at 2 o'clock at kdow.biz. So join us for that. Some archive shows that I think are really relevant, especially for today's call. When I was thinking about today's webinar, I was thinking about, sort of updating people on what's kind of going on in the market in 2014, what we expect in 2015. In October, I really focused my radio show on individuals that are in the market, that are doing stuff in the market, that have great experience in the market. These are all really good to listen to. If anybody wants to listen to any of these, I have all these archived. I can send you out a copy on the podcast. Jason Gautreaux, they do financing. I'm going to talk about financing today. Jason's interview was excellent. If you're looking to get financing for a real estate investment, I would encourage you to listen to that one. I had Julie Harrison on. She's in Mississippi. I'm going to profile a couple Mississippi properties today. Julie is an amazing woman. She was voted one of the top 3 most powerful, influential women in the state of Mississippi this past year. Dan Noble with Summit Assets Group. There's some people on here today. I know you came to us through Summit Assets. They were advertising today's webinar as well. Dan and Lori have been doing investment real estate since 2000, so that means they were doing this before the bubble burst, which is kind of interesting. And that had some really good information about how you might consider investing. And then Ryan Pullman has probably purchased more real estate than anybody else in the country in the last 5 years. He owns a company called BuyPD. They project $180 to $200 million in sales in 2015. Fascinating interview. I learned more from that 1 hour. I could have interviewed Ryan for 2 hours and still would have been having questions to ask. It was a really good interview. Coming up on November 20, we have Sean Tierney with Havenbrook Homes. Havenbrook is the 3rd largest owner of single-family homes in the country. Sean is their buying manager. He'll be my guest on November 20. You might want to tune in for that one as well. So let's just take a look back on what we've seen in 2014. Some of the changes that we saw in 2014 in the housing market. First thing, inventory certainly decreased. Prices are going back up. It is getting harder to find good inventory in some markets. Now we're going to talk about what some markets over other markets. Certainly in some parts of the country there is more inventory available than others, but certainly inventory has gone down. Prices continue to go up, and there are bubbles in some markets. California, Arizona, Nevada in particular, those 3 markets I would consider to be markets to be very careful when you invest in those markets, because and I'll show you some statistics here in a few minutes about a few of those markets, but those markets are really capped out now from the investor perspective. You won't see a hedge fund in those markets. You'll see very few small buyers in those markets unless they have some sort of a relationship to somebody that can find them inventory that most people don't find, which is typically off-market type of inventory. Hedge funds stop buying in bulk. Now, to some of you, that may mean nothing, but let me explain what that means. The hedge funds have been very prevalent in this market, and I'm going to talk about hedge funds in a few slides, but typically hedge funds over the years have purchased in bulk, which means they would buy bulk lists and tapes from the banks. They would also buy bulk packages, which means they would buy a percentage of their inventory would always be underperforming or non-performing. They've stopped doing that. Matter of fact, there's only one fund that I work with throughout the country, which is a stark contrast to what it was in early 14 and certainly 2013 and 2012. There's only one fund that will buy bulk. Everybody's cherry picking. And there's reasons for that, and we'll talk about some of those reasons today. And what does that mean? It has a lot of implications for the market, actually, because what the hedge funds were doing was they were buying up inventory that nobody else wanted. And so that stopped now. That low-hanging fruit, they're not picking that stuff up anymore, so they've stopped doing that now. Specialized REO companies have dwindled. What does that mean? For those of you that don't know what a specialized REO company is, it's one of those companies that came into existence in 2008 or 9. They were buying up inventory. They were then reselling it to smaller investors like you. This time last year, there were still a number. I worked with a bunch of specialized REO groups. I know not most of them. I know a bunch of them, put it to you that way. And I worked with a lot of them. I had a lot of them on these webinars. I had Summit Assets Group in. I had REO Reseller on. I've had Premier Equity Group on. I've had a bunch of these different groups on. Those groups are being challenged now because the key word now is buying direct. It's buying direct from the selling party. That means you as the individual, just like a hedge fund buyer, can buy direct from the individuals that own these properties. What does that mean? Lower prices in some cases. It means higher yields. It means typically cutting out fees in the middle, so you're not paying a whole bunch of fees to a bunch of guys in the middle of that. So the key word now is buying direct, And there's a lot of ways to do that. Of course, you contact us, we can tell you exactly how you go about doing that. The biggest change, however, in the market in 2014 was financing. If there's anything that's changed for the individual buyer, for people like you who may want to buy one house through your 401k or your self-directed IRA, it's that now there's financing available, and it comes in all shapes and sizes. I'm going to feature a few of them later on in my webinar. But there's smaller lenders, which I'm going to talk about, that are offering financing in select markets on select properties. You can get some pretty good non-recourse lending for properties in certain markets with certain properties. And I'll explain why there are certain properties that they have to finance. And the reason, frankly, is just simply that if they don't finance a property that's under market value, the lender doesn't feel they can get their value out of it. Now, what does that mean for you? It just means if you buy something that they're willing to finance, it means you're buying it under market value. But those smaller lenders do now exist. B2R Financing, a division of Blackstone. If you don't know who Blackstone is, they are the largest owner of single-family homes in America. They own 48,000 homes. They launched that in late 2013, about a year ago right now. Actually, it was last October, I believe it was. And their goal and focus is to serve the medium to larger buying community. So what does that mean? It means if you own 5 houses and you want to own 15, you need financing to get you there. B2R Financing has a really attractive finance piece to help you grow your portfolio by simply leveraging the properties that you do own. It's an excellent source of financing that you should, if you're in that category of investor, you should take a look at. And then finally, there's Security National Mortgage. And I spoke about my archived radio shows about Jason Gautreaux. That's who I was talking about. Fascinating. They're financing in 42 states. The loans are fairly low interest. They can either be an owner or tenant occupied. So in other words, if you're looking to buy a home for yourself, you may talk to them. If you're looking to buy a home as an investment where there's a tenant occupying the home, they finance those as well. Their fees are extremely low. Their structure is outstanding. They are by far the best non-recourse lending source I have seen. So if there's anything that we've seen in 2014 that's really changed to the benefit of the smaller buyer, it's the fact that you can now get financing to purchase investment real estate. I talked about bubbles, so let's talk about, this is from Trulia. This is actually, I should have updated this. It's changed a little bit. The most overvalued real estate, according to Trulia, was in Orange County. That's where I live, Fullerton, California. Honolulu was second, LA third, Riverside. If you notice there, by the way, if you live in California, you notice that every county in California, with the exception of the San Joaquin Valley, Fresno area is listed there. You got Orange County, you got LA, Riverside, San Jose, Oakland, Ventura, Sandy. The whole state is considered to be overvalued. So when I talk about being careful investing in certain parts of the country, this is the reason why, because they're considered to be extremely overvalued. By the way, what changed here was, believe it or not, Riverside, San Bernardino, the latest update was like just a couple days ago, and I didn't post it, but that is now considered to be the most overvalued property in the country. And Austin, Texas is now number 2. And then you get to the most undervalued. Now, this is where hedge fund buyers typically focus their attention. They typically focus in markets that are undervalued. And you're looking at some of those markets here now. These are some of the markets they would consider to be undervalued. And this is where, you know, when I tell the smaller investor looking to invest in one single-family home or 3 or what have you, and they say, well, what markets would you buy? And I said, man, follow the hedge funds. The hedge funds, these guys spend countless hours trying to figure out where the best place to invest their multi-million-dollar funds. And so they spend a lot of time thinking through this stuff and doing lots of research. And these are the kinds of places that they look for. Now, there's one market on here you see 3 times. You see Ohio on there in 3 places. So Ohio is a market that, from everything we can see, is going to be a big market in 2015 for the hedge fund buyers. But you got like Detroit. Now, lots of people look at Detroit and they say, why would you invest in Detroit? Bottomed out, right? In 2008, the automobile industry crashed. You had the financial world crash, and then you had the housing market crash, and that all affected Detroit to the point where they filed bankruptcy. So a lot of folks looked at that market and said, well, who'd want to invest there? But other folks, like the hedge fund guys, look at it and say, well, it's gone down this low. It's only got one place to go, and that's back up again. So that's a market they're starting to pay close attention to. I'm going to give you what we see as being the markets to invest in. These are the most undervalued markets in the country. It doesn't always mean they're the best place to invest, and I'll give you some examples of that in a little bit here. Yes, we are seeing an influx of Asian investors into the U.S. real estate market. This is just from a couple of days ago, October 27th, and it just talked about, during the recession, foreign investors were buying commercial real estate. It fell dramatically, but now we're seeing a rebound in cross-border investment dollars into real estate. There's a lot of different Asian investors in our market, particularly Chinese investors. We know that a Chinese group just recently invested $500 million in Blackstone, so they recognize the value in investment real estate. we suspect that in 2015 you're going to see more and more of these kinds of groups entering the market looking to purchase investment property. This is also the same from the same, or no, different article, but the same topic from CNBC, and it goes into why is the level of Asian capital into the U.S. real estate recovering so aggressively. There's two reasons that they cite. There's too much capital chasing too few investment opportunities, and that includes real estate. So lots of capital, not enough investment opportunities. The second reason is the one that I really sort of caught my attention. It's become a particularly enticing investment alternative globally as investors search for yield in relation to risk. So risk reward. When you look at real estate, you talk to all the hedge fund buyers, they all have a little bit of different view of the market and how they buy, but the reasons that they buy are pretty consistently the same. One of the things they will constantly say is it's the best place to invest your money in America today. They view it as a commodity. Real estate's a commodity. It's not going to crash and go away like your money could in the stock market. It's a commodity. You're getting rental income. You're cash flowing. You're in a market that if you buy in the right places is going to continue to appreciate. And so what this here says is the same sort of thing. Yield and risk. They get high rates of return. If you buy in the right place, you should easily be looking at 10 to 12% or higher return on investment on your investment dollar year on year. And then you should also be looking at a rate of appreciation. The value of the property should be climbing over the next 5 years. You should be getting both of those if you invest in the right markets. Now, obviously, if you invest in a place like California or Las Vegas or Phoenix, you may not get that sort of appreciation. You might even lose some money, but you might still get some decent yields. But the foreign investor views this market just like the hedge funds do. You get a nice yield, and the risk is not that great if you buy the right product. And I'll talk about some of the keys to buying the right product. Are hedge funds becoming the market in real estate? This is from CFA. This is just an article I read just a couple of days ago. This was an article in the Atlanta Journal-Constitution about a family that looked at 80 houses, and they couldn't get any of them. They continually made offers on properties. They couldn't get any of them. Why? Because the hedge funds were buying them faster than they could get to them. And so what the article went on to talk about was the hedge funds. Now, we all know that the hedge funds have been strong in this market for a number of years now. As a matter of fact, if you look back statistically at 2013, Credit.com reported that of all the homes sold in America, that 44% of them were paid for with no loan recorded at the time of the sale. So it was a cash purchase. Now, what does that say? It says that investors are buying real estate. And so that hasn't really changed any. That's pretty much what we're seeing today. They're seeing better returns in real estate with less risk than any other investment that they can find in the market. So what you're seeing is the hedge funds, is becoming a market for just hedge funds, sort of. Does that mean it can't be a good market for the smaller investor? Absolutely not. If you know how to buy correctly, you know what markets to buy in, and you pick the right partners, which is key, you can have the same sort of success as the hedge funds can. Now, for those of you that don't know this is Warren Buffett. This is what he was recently quoted as saying. I'll read it in a second. But you may or may not know Warren Buffett in October of 2012 purchased Prudential Real Estate. It's now branded Berkshire Hathaway Home Services. And at the time that happened, everyone thought this is exactly what Warren Buffett was going to do. And he goes on to say here, if I had a way of buying a couple 100,000 single-family homes, I would load up on them. It's a very attractive asset class. Now, I could buy them at distressed prices, find renters, take a mortgage. It's a leveraged way of owning a very cheap asset, and I think that's an attractive of an investment as you can make. The article that this was quoted from went on to say, the hedge funds have moved in there where Buffett has not. And then it goes on to say yet. And the implication is that Buffett is getting to a point, Berkshire Hathaway Home Service is getting to a point where they're going to enter this market in a big way. I think that's true. I think in 2014 or 2015 rather, you're going to see not only the hedge funds that are buying now to continue to buy, but I also think you're going to see people that have not been in the market. They're going to start jumping in. I think one of those entities will be Berkshire Hathaway Home Services. And so people ask me all the time, is it too late to get in? I started looking at this market back in 2008, 9, 10. Certainly, that was the right time to buy, right? I've missed the market. I missed that opportunity to buy. And I've been saying all year long this year, for those of you, I know there's a bunch on today that have been on these webinars throughout this past 12 months. I said this year, no, I don't think so. If you buy right and you understand where to buy your inventory from and who to manage it for you, if you can marry those couple of things together, 2014 is going to be the best year to buy. And as it turns out, it was. It was the best year that I've seen in this market, not only for the institutional buyer, but also for the individual buyer. And for those of you that have been around these webinars for a little while, I'm going to show you a couple of slides here of homes for prices that you haven't seen in a couple of years for properties that are better quality properties that you could get even 2 years ago. So the question then becomes, how does the individual buyer compete in this market, the smaller buyer? These are sort of 7 tips that I sort of hand out. First of all, buy below market value. You want to buy directly from the selling party. You do not want to buy anything that's on the MLS. You want to buy off market. If you don't buy it off market, you're not going to get the best price. Always you want to enter the market below market value. Now, by the way, these are 3 awesome tips, right? This is exactly what hedge fund buyers do. They buy below market value. They don't buy through a bunch of middlemen, and they don't buy anything that's on the MLS. Now, there's a few groups that do buy on the MLS, but it's rare, and they usually only do that as sort of a leverage play, and I won't bore you with what they do there, but there's a strategy that a couple of these folks use to sort of tie up the market by using the MLS as sort of a leverage play, but they really don't want to buy off the MLS. You want to look for both year-on-year return or year-on-year appreciation and ROI. What does that mean? Buy in a market where you can get a good ROI, cash on cash in your money, but it's also a market that's appreciating. It still has room to grow. If you buy it for $50,000 today, you want it to be worth $75,000 in 3 or 4 years from now. You can get both if you buy in the right market. Have your infrastructure in place. I cannot talk enough about property management. Property management is really key, and it's not easy to find good property managers. Now, I've been doing this for a little while, so through trial and error, I've been able to find who the good guys are and who the not so good guys are. But your property management is key, and I will never recommend anybody buy a piece of property anywhere without having a property manager already in place, one that's been vetted, one that you can verify that they do a good job for their customers. It's extremely important. Number 6, understand your strategy, both short and long term. Don't go into a deal, a long-term buy and hold, and then decide to flip it in 6 months. That's a bad strategy. At the same time, don't go into a flip if you're not really intending to flip it. And the reason I say that is what you buy will have a lot to do with what your strategy is. If we understand your strategy, then we can help you buy the right piece of property. By the way, incidentally, hedge funds, they tell you what they want to buy before they even enter the market. They'll go into a market and they'll say, okay, you want 3-bedroom, 1 bath, it's got to have at least a carport, it can't be anything older than 1950, it's got to rent for at least 7. They know their criteria. You should too. And then finally, only buy fully rehabbed and rent-ready property. A year ago, I still saw groups that were selling property that weren't fully rehabbed or weren't rented yet. If there's any mistake I've seen smaller investors make more than any other thing, it's that. It's buying something that isn't done. You want to buy something. Now, I'll show you a couple pictures here in a few slides, and I'll show you what we consider to be done. Markets that we consider to be focal points for 2015. Now, why do we say this? I say it simply because I deal with these funds every day, and I see where they're going. I see what markets they want to invest in. These are, now I'll just real quickly, Memphis certainly has been a strong market for a number of years. It will continue to be. Atlanta, I see going down the other side. Atlanta's getting harder and harder to find good inventory with good yields that you can make money on, short or long term. Birmingham's still an excellent market. If you want high yields, you want high rates of return, you want to be in a market that's still appreciating, that's not capped out yet, Birmingham's an excellent market with some excellent operators in that market. I put Ohio because it really is the entire state. There's about 4 markets in Ohio that I think are going to get a lot of attention in 2015. Kansas City and St. Louis both. Jackson, Mississippi is an excellent market. I'm not going to bore you with all the details as to why. I put Houston, Texas in here because I've had a lot of activity in Houston the last couple months, but I actually think it's more than that. I think it's Houston. I think it's also Dallas-Fort Worth, and I think it's also San Antonio. I think all those markets. Now, there's one downside to Texas, and there's some tax things in Texas that does not make it a friendly state for the outside investor. But I believe that Texas will be a strong market as well. Just some examples. I'm going to turn it over to Brian. So, Brian, load up your webinar. We're almost to you. So just some examples. For those of you that have been around a while, this is a property in Birmingham, 3-bedroom, 1 bath, renting for $775, offered at $47,000, a 15% rate. These houses are completely done, by the way. I'm just going to give you some examples. Another example, this one did sold. This one sold yet. I did my PowerPoint yesterday. I got word this morning this one was sold. But another example, an $850 rental for a $53,000 offering price, so it's a 14.8% ROI, cash on cash in your money, in a market that's still climbing. These houses are completely rehabbed. Now, I talked about financing. You can finance. Now, there's 3 markets you can finance in. I'm not going to go into the details because I want to get to Brian. But if you want to get information on where you can finance properties at, contact me. There's 3 markets now where there's non-recourse lenders that will loan on certain properties, and these returns are pretty strong. This is a $42,000 asking price. It's rented at $800. After taxes, insurance, and property management, they're only asking for $13,000 down. So your monthly payment's $241, your net cash flow is $388. So you got a 35% cash on cash return on that $13,000 you're going to put down. It's a 10% interest-only loan for 5 years. I can give you all the details on it. These are a little bit unique non-recourse loans, but I've had lots of people over the last 5 years that have said, man, I don't have that much cash. I got a 401k. I got 10 grand in it. How can I leverage that and buy some investment property to help build my retirement portfolio? That financing was not available, and now it is. And these are all newly rehabbed homes, by the way. All these homes that I showed you in these slides, if they don't look like this when you go to buy them, don't buy them. If they're not rehabbed and look like they're brand new inside, that's not what you want to buy. You want to buy something that's finished. Same type of thing, and I'm almost to Brian, so the same thing, $47,000, $15,000 down payment. You got a net cash flow of $299 a month, so you got a 23% cash-on-cash rate of return. You can do financing like this now in Jackson, Mississippi, Birmingham, Alabama, and in Nashville, Tennessee, and Memphis as well. So financing is now available out there. It's rare to find these types of deals where you can finance into something so low. And again, just as an example, just when I talked about it being fully rehabbed, they should be fully rehabbed. They should be done. Now, these are all before the renter took possession, but it gives you a pretty good idea what they look like after they're finished. But you don't want to look at anything that is not completely finished. So that is my presentation. That was a short, abbreviated presentation today, I know, but I wanted Brian to get his share of airtime here. This is our last webinar this year with Brian. I'm going to now change presenter, Brian, so I'm going to hand the controls over to you.
All right, thanks. And Charlie, I'd like to get some more info on those other non-recourse lenders, because a lot of people ask me, who are some of these lenders, and I don't think I recognize that main one that you were referring to.
I'll tell you the story real quick. These guys were financing properties in the Balkans, and they called me up one day and they said, we'd like to go on your radio show and advertise our product. I had no idea, but these guys are financing in 42 states. They do an excellent job. Yeah, if you want some information, contact us for sure.
Yeah, I'll hit you up later for that, Charlie. But thanks again, and thanks for having me. A lot of good info there, Charlie. As always, I like how you change it up there, and we got the outlook for 2015 today. For those of you that don't know me, I'm Brian Davis with Accuplan. I'm based in San Diego. I'm Director of Business Development. Before we get going further, a little disclaimer I always have to read when I do these types of presentations, that we are not financial advisors or broker-dealers. We are administrators and can help you direct your IRA funds, but a self-directed IRA means you're the one taking charge of the direction of the investment, not us. All information here is for educational purposes only. So again, Brian Davis with Accuplan. My background is a little unique. I'm from Northern California originally, north of the San Joaquin Valley, north of Sacramento, so I guess still kind of San Joaquin Valley, but not one of those markets that Charlie was pointing out there. My parents are rice farmers up there. Then I went to college at UC Santa Barbara, down the coast, just north of LA, and graduated in 2001, and shortly after moved down to San Diego, and been here since 2002. I got into the real estate industry. I was doing mostly subprime loans for a builder division of Wells Fargo Home Mortgage here in San Diego. So in 2007, all of a sudden, subprime went away, and the builder went away. People weren't buying new construction properties. The value just wasn't there. So I stumbled around for a year or two doing life insurance and annuities and health insurance before finding my way into self-directed IRAs, which I had never heard of. I did not know you could buy things like real estate in your retirement plan. And now I've been with Accuplan for the last 2.5 years. I've been in the business for over 5, the self-directed IRA. So I have Accuplan, one of the premier IRA administrators holding self-directed IRAs, traditional Roth, SEP IRAs, and simple IRAs, and solo 401ks. And we have our own trust company called American Estate and Trust, which is out of Las Vegas, Nevada, which is what allows us to be an IRA custodian. So I'll get into that just a little bit. But for most of you, you might or might not know much about self-directed IRAs, and you're not alone. Traditionally, the RISA Act was passed by Congress in 1974, outlining the retirement system that we have today. It basically said you had to have an IRA custodian to hold an investment in an IRA. Well, what's a custodian? Brokerage houses, banks, and insurance companies. That's been the norm here. Those types of custodians, they hold publicly traded assets, the stocks, the bonds, the mutual funds, and they've been dominant in this industry since that started. But other custodians, like that have their own trust company or could hold alternative assets, have come into play, and that's where we come into play. We're a custodian that holds alternative assets. And by alternative, I mean non-publicly traded assets, things like real estate, notes, unsecured notes, precious metals, and investments in private companies. That's really what we focus on and what we see here. Now, this is an older slide, $4.7 trillion in IRAs at the end of 2010. That number is closer to $6 trillion, or I think even slightly over $6 trillion, the last numbers I heard. I'm actually waiting to get an updated number to update this slide. And if you account for qualified retirement plan funds, which are plans like 401k funds and pension funds, there's over $16 trillion in retirement plans. Only about 2% of those plans are in a truly self-directed vehicle, so something that allows them to invest in things outside of the stock market, things like real estate notes, you name it. So this number is starting to grow, and a lot of that is due to the market crash, 2008 and 9, and people looking online and saying, what are my options here? My 401k plan got destroyed. What can I do? And people have found different investments like distressed real estate as to be a very healthy alternative. So again, what we're mostly seeing, like I said, is real estate, notes, investments in private companies. Occasionally I see the precious metals investor, but for some reason I just don't see that client. I'm mostly seeing people investing in real estate and private businesses. But there's all types of different investments your IRA can make. As you can see here, renewable energy, water rights, promissory notes. The list can go on and on and on. Back when this retirement plans were written, and the RISA Act was written, they really only said what you couldn't invest in your IRA, not what you could. And they really listed only two things: life insurance contracts and what the IRS deems as a collectible. And this is a list of what the IRS deems as a collectible: work of art, rug or antique, metals or gems, stamps or coins, alcoholic beverage, anything illegal. And they even made a change to the stamps and coins to allow certain coins to be allowed to be held into your IRA. You'll also hear, if you've done much studying on self-directed IRAs, S-Corps. That's an S-Corp rule. S-Corps only allow naturalized persons to be members of an S-Corp. So IRAs, by nature, can't invest directly into an S-Corp, though I've had plenty of clients loan money to other people's S-Corps. So, sounds simple, right? Well, that's kind of the easy part. No investing in life insurance contracts, no investing in collectibles. But there's another piece here. There's something called a prohibited transaction. A prohibited transaction, and I'll try not to use too much jargon here, and please, I know that there's a chat box. If anybody has any questions, feel free to write those in. Prohibited transaction is when your IRA gets involved with what's considered a disqualified person. And you kind of want to think of this as kind of an arm's length transaction. And you can all look this up if you look up Internal Revenue Code 4975. But essentially, there's no self-dealing in your IRA. Besides no self-dealing with yourself, think of family members in lineal ascension and descension. So your parents, your grandparents, your children and their spouses, grandchildren and their spouses. Those are all disqualified persons, so you can't transact with one of those persons inside your IRA. And the penalty for doing so can be quite severe. The IRS could come in, go back and look at a transaction inside your IRA and decide, you know what, that's a prohibited transaction, and they can disqualify that IRA as of January 1st, the year that that prohibited transaction took place. So you really want to make sure you keep an arm's length distance on your transactions. If you have questions on specific transactions, that's when you talk to somebody like me, and I can help at least direct you in the right way. To help drive this point home a little further, play a little game here. Everybody probably remembers the game Deal or No Deal from NBC a few years back. But let's see how you can understand the rules here and how it can get a little tricky. Can your IRA lend yourself $10,000? Deal or no deal? The answer to that is no deal. That's the definition of self-dealing. Now, that's different from a 401k plan. 401k plans, you can take a loan out, but we'll get to that in a later. But for the IRA, you cannot lend yourself money. What about your brother? Can you lend your brother $10,000, deal or no deal? You can, It's allowed, but again, that's up to you. And one thing I like to point out here is you don't want to try to skirt around the rules of you loaning your brother $10,000 and then him just loaning it back to you. The IRS could say, oh, you're indirectly just, subverting the rules, and so that could be something to look out for too. So you can't just, okay, that one's not particular, just qualified person, and I'll just have it end up back to me. You really do want to keep your nose clean here. But your brother is fine as long as that's a legitimate transaction. And what about your stepson? Could you loan your stepson $10,000, deal or no deal? This one is deal. If it was your son, it would be no deal. But your stepson, they've said that is far enough away that that is okay. What about your daughter-in-law, $10,000, deal or no deal? That one's no deal, your children and their spouses. So again, it can get a little tricky, and if you have questions, that's what people like me are here for. So let's get some more of the fun side of this self-directed IRA. How do I get started? How do I put money into an IRA? Well, like I mentioned earlier, we have IRAs like everybody else. So just like the major brokerage houses, we have traditional IRAs, Roth IRAs, SEP IRAs, simple IRAs. So what you'd do is we'd open up a corresponding IRA, like a traditional IRA, let's say, and we would do a trustee-to-trustee transfer to move your cash from your existing IRA over to your IRA with us. There's no tax implications for doing so here. Another way to do it is if you have funds in a qualified plan, like a pension plan or 401k, you'll want to contact the old plan administrator for that old retirement plan and request a direct rollover. So they make the check payable to your new IRA with us. I get asked here a lot, what about my existing retirement plan at work? Can I move that over? The answer to that is maybe. Some qualified retirement plans allow what's called an in-service rollover. So you'd have to ask your plan administrator if the plan allows an in-service rollover, and if it does, then you could move some plans into an IRA, whether it be self-directed or otherwise. But that's something that depends on the exact type of qualified retirement plan, since there's a lot of different variations of that compared to the IRA. And then last and not least, you can make an annual contribution to your IRA. Now, just in the last week or two, just been realizing that next year in 2015, can't believe that's already coming up, these numbers are going to jump just a little bit. But for 2014, since we're still here, you can contribute up to $5,500 to a traditional Roth IRA. If you're over the age of 50, you can throw in an extra $1,000 for a catch-up contribution. And you have until April 15th to make these contributions. So December 31st in your guideline here, it would be your tax filing deadline of April 15th. And then I'll talk quickly about a SEP IRA, since I see this quite frequently. A SEP IRA is a self-employed pension. It works very much like a traditional IRA in that it's pre-tax, but it's for a self-employed person and possibly their employees, where they can convert or they can make annual contributions of up to 25% of their adjusted gross income. The cap on that for 2014 is $52,000, and you technically have until October 15th next year to make that contribution, as long as that's when your tax filing deadline is pushed to. The simple IRA works very similarly to a 401k plan. This is for small businesses. It allows you to defer some money out of your paycheck to a plan. It is also a pre-tax retirement plan. I don't see that as often. And then I really do want to talk about the individual K, or here called a solo K or a solo 401k plan. That is a plan for the self-employed individual with no W-2 full-time employees. So different than a SEP IRA, this is a 401k plan. It is not an IRA, it is a 401k plan. So just like a company 401k plan, except for it's for that sole proprietor. Whether you're incorporated or not, you create your own 401k plan. You can make contributions as the employee, and then you can do the company match as employer, and I'll get into that later. It's a lot easier to make the maximum contribution here as opposed to the SEP IRA. We call our product the 1K at Accuplan, and it works very simple. It's a self-trustee and administered plan. You are the trustee. That's another word for custodian. You are essentially the custodian of your own 401k plan. You are also the administrator, however. That's an optional piece. If you want us to be the administrator, some extra piece for that. But most people are able to figure out how to do the administration themselves here and save some money. And you can invest directly from the 401k plan into an investment, or you can put some intermediary vehicle like a trust or an LLC in between to invest in the LLC. So whether you have a company or not, this graphic shows you would create a 401k plan for that self-employed business. Doesn't matter if you're a sole proprietor or you are incorporated. You can roll over any pre-tax IRA dollars or old 401k dollars you have into the plan, because those funds can be moved back and forth. And then you can start making those annual contributions and then go invest directly from there. There's some big benefits to the plan. You can obviously buy these alternative investments like real estate. You can loan yourself money from a 401k plan as a plan participant, which is something you cannot do in an IRA. So you can loan yourself up to $50,000, depending on the size of your 401k plan, and then you pay back your own retirement plan. There's also a Roth deferral option. So some of the funds that you can make contributions to in the 401k plan can be after tax or Roth deferral. And again, if you have more specific questions about this 401k plan, let me know. It's just a great plan because it comes with checkbook control, which is different than the IRA. The IRA, however, can have checkbook control, but you do have to create a separate entity for that plan to have checkbook control. And there's been a couple prevailing options out there, and really kind of depends on what state you're doing business in of how you want to set this up. But the main model out there has been an LLC model. In the LLC model, create an LLC. The IRA is the member of the LLC, and the IRA owner becomes an unpaid manager, so they don't break any of those disqualified persons rules. So federally, tax-wise, it's a pass-through entity if there's just one member, just one IRA, but you can have more. So there's no federal tax to necessarily worry about filing there. But you do have to file with the franchise tax board of your state. I'm in California, so a lot of my clients and potential clients are doing business in California. Well, California charges $800 a year plus a gross receipts tax if you have a lot of business going on in that plan. So you could have an extra larger bill by having an LLC, which is why the business trust has come around. A business trust is a specific type of trust that's taxed like a partnership, which is just like an LLC. So federally, it's a pass-through entity. In this situation, the IRA becomes the beneficiary owner, and you make yourself an unpaid trustee. So very parallel, words compared to the LLC there, except it falls under the trust guidelines with the state and doesn't have to file with the California Franchise Tax Board, saving you a good $800 plus a year by having this. And I have more information online on this product at retirementcheckbook.com. But for opening the IRA, you don't have to do that checkbook control if you don't want to. I'd say a very small percentage deal. Some people just have a couple passive investments. This is how you do it. You open up an account online with us. We work on funding the account via those three methods we talked about: transfer, rollover, contribution. And then you provide us a bi-direction letter directing us to invest in the asset of your choice. And we're generally about 2 to 3 business days on moving those funds to the investment. So that's all I have now. And here's my contact info, Brian Davis at Accuplan.net. You can check me out online at AccuplanSanDiego.com or RetirementCheckbook.com. And my phone number is there at 619-892-2438. Charlie?
Awesome, Brian. I got some questions. As people are loading their questions into the queue, I got a couple questions for you, Brian. But first, if you want to ask a question, if you look to the right of your screen, you have a dashboard, and down below there's a little button that says questions. If you click on that little button, a little screen will pop up. You can type your questions in, and we'll be glad to answer your questions for you. Brian, the first question I have is the 1K plan, is that new?
No, it is not new. It's been around, but it's not widely used. The custodians, it's not as cut and dry as an IRA. Pretty much anybody can have an IRA. You really have to have a self-employed business of some sorts generating some type of self-employment income to have that solo 401k plan. And not everybody kind of fits that mold of that profile. But I think a lot more people can than they think, and you just got to understand the rules of doing it. And it's something, when I talk to a client that is going to do this plan, I say, let's do a three-way call between me, you, and your CPA or financial advisor, because depending on the circumstances, they might have other businesses that could disqualify them from that, and then a SEP IRA might be better. So it's really dependent on the individual. So it's just something that more people need to know. And another benefit for your clients, if somebody's using leverage to buy a property like this, if they do that in an IRA, there's a tax associated with it called unrelated debt financed income. The 401k plan is exempt from that tax. So you can leverage through this solo 401k plan and not worrying after having your retirement plan pay a tax on it.
Okay, so and I'm asking these questions because I get asked these questions a lot too, Brian. I don't know the answers to some, but it sounds to me like the type of plan you would use is dependent upon the personality of your situation, correct?
Correct.
So for those that are listening, because I know I see a couple people on the line today that I've talked to in the last 2-3 weeks that have asked these sorts of questions of me, and I don't know the answers. The answer is call Brian and let Brian get a better, right, Brian? Just you need to talk to folks to get a better idea of where they're at personally, and based upon that is what you'd recommend the direction they go in, correct?
Exactly, and I'll just say this. If you fit the profile for the solo 401k plan, it's a seemingly superior plan. Now, obviously, that could vary depending on your situation, but there's so many extra benefits to it compared to the 401k. I really don't see how it's not.
Yeah, okay. Okay, so the first two questions that came in, they're sort of both directed at both of us because they're both about fees. One was about how much are title and escrow fees. I'll answer that one. Title and escrow fees are somewhere between $500 and $750. So it's not a huge number. Depending upon what you do, I mean, I always say, get the seller to pay the escrow fees and that sort. We can talk about that. Those things are all negotiable. Sort of goes hand in hand with another question, which is, are these prices that you had in the screen firm? The answer is no. Real estate, like anything else, is always negotiable. And as a matter of fact, the house that was sold that I showed on the screen, that was asking at 53, and there was an offer taken on 49 on that. So we'll take some backups on that too. And then Brian, the second part of that question is to you, and I've got a follow-up question to this actually. What's the cost in setting up a self-directed IRA?
Self-directed IRA, I'll break down the IRA versus the 401k. The IRA is a $50 setup fee and a flat annual fee of $275 a year. Some other small fees can kick in, like wire fees are $15 each way. If you have a lot of dividend income payments coming in, there could be some extra small charges down the road, but the basics of it are $275 a year and a $50 setup fee. The solo 401k, a little bit of a different product. There's a one-time setup fee of $1,000, and you're done. You're off and running with that product, and you're good to go. Okay.
Okay, that's good information to have. Okay, so the next question I have was relating to Montgomery, Alabama, and the question specifically is, are we also in Montgomery, Alabama? You're already invested in Memphis, Tennessee. Interested in my thoughts on Montgomery. Here's my thoughts on Montgomery. Montgomery's a good market. There is available inventory down there. If you email me, I'll put my number back up on the screen here in a second. If you email or give me a shout and let me know what your buying criteria is, I can certainly get some property to look at. It's a good market. I don't think it's as good a market in Birmingham, but here's why. Nothing wrong with Montgomery at all, but here's my thoughts. In Birmingham, I've got wholesalers down there that I've worked with for a number of years now that I can give you a list of people that have bought properties from these guys that are happy. So you're going to get newly rehabbed, rented, brand new leases on properties with yields of anywhere from 12 to 15, 16% in a market that's still going up. Birmingham is a market that, according to CNN Money, was the 8th hottest housing market in 2014. So we know that about Birmingham. The other thing we know about Birmingham is that we have property managers down there that do an excellent job. There's one group down there in particular that manages for for a number of the larger hedge funds that are in that market. They do an excellent job. We have gone through a number of different property managers in that, like in every other market, of course. The Birmingham is no different. You have to go through some of the how do I put this, less effective property managers to finally get to the ones that do an excellent job. We know that. So as I mentioned earlier, the two keys to success is buying under market value, good property that's rented and rehab, performing, brand new rehab, brand new lease. Marry that up with an excellent property manager, and you're off to the races. You now have a passive investment that's going to turn, put money in your mailbox or back into your 401k every month. I like that. Does that mean Montgomery's a bad market? Heck no. Memphis, Tennessee is a great market. St. Louis is a great market. We've been doing a lot down in St. Louis lately with another hedge fund. Toledo, there's lots of great markets. But if I was going to compare Montgomery to Birmingham, I'd ask you to take a look at Birmingham to think what you get there for your dollar, not only the properties, but also coupled with the property managers that we know do excellent work. I sort of like that. I like that combination a whole lot. Let's see what else here. Okay, got that one done. Can you discuss fees? We talked about that. Is investing in a duplex a good strategy? Great question, and here's the answer to that. Duplexes, triplexes, apartment houses are always a good strategy because you got multiple units, right? So if you buy a single-family home, you have one house, one tenant. Tenant moves out, cash flow goes away. Yeah, you're going to rent it again. Occupancy rate right now, Blackstone reported last quarter was 94%. So we are living in an excellent rental market right now. So even if you go vacant, you're still going to get another renter in there in a short period of time. But if you have a duplex or a triplex or an apartment house, and you've got 10 units or 5 units or 3 units, and somebody moves out, you're still cash flowing, right? You don't lose all your cash flow. The caveat to multifamily, I have to point out, is I almost never, I've been doing these webinars 5 years, I don't think I've ever advertised on these webinars a multifamily unit. And the reason for that is when we get them, they go really fast. We know who's interested typically in multifamily, and they don't really even go up on our website or really even go out to the market. We usually just call somebody up and say, hey, we just sold an 11-unit apartment house in Birmingham. We didn't go any further than one phone call. We knew exactly who would be interested in that property. We closed on that last week. So is investing in a duplex a good strategy? Yeah, they're just not they're not always available. So I would just say if you're looking for something like that, to contact us and let us know what your buying strategy is, and we can help you find that. And by the way, that goes across the board, not just for multifamily, but particularly in multifamily. They're just not, you just don't get those every day. Okay, we have anything else? Only one more question here. I guess then we'll sign off. If you don't, I'm going to put my stuff back on the screen, Brian, real quick here.
Perfect.
I'll put my stuff back on the screen here and put my phone number up there for a minute. Let's see. Show my screen. Okay, put my number back up here. If you've got questions, give me or Brian a call. We'd love to talk to you. I did get a request during this webinar about the podcast. If you're interested in any of the podcasts, just let me know. We have them in a queue. We can pull them off the radio station. So if you'd like to listen to any of those, give me a shout. And I guess that's it. Those are the last questions we had. Did I have another one? Oh, no, we did have one more. What was my opinion of the market in Ohio? I'll tell you something. Ohio has been a market over the years where I would say the level of success for the smaller investor was limited. I'm being kind here, okay? However, that market, for whatever reason, has really seemed to have caught the attention of a lot of hedge funds. And I only know one, that's not true, I know 2 groups down there, one in Toledo, one in Cincinnati, that do really good work. And so I think that's a market where in 2015, I think we're going to be in that market. I think it's just going to be the natural evolution of things, that will be a market that we'll just naturally sort of migrate to. Clearly, statistics are saying in that market you can get great properties there for really good values, and the market's climbing. And that's what the hedge fund guys look for, is where the market's still continuing to have room to grow. I would say, though, however, remember something. A lot of people say, what's the best market to be in? And I'll say, you know what, that's a great market, but remember, the 2 key things for you to be successful, well, 3. The market, yes, absolutely, be in the right market. But then also your partners. You want to make sure you get great wholesalers that get you good properties that have quality rehab work done. And then you want to make sure you got a good property manager. So those 3 things are what will make you successful. Not just the perfect market to buy in. If you get a great house in a great market, but you don't have anybody to manage it for you, or you buy a property in a market that's a great market, but the guy you bought it from didn't do the work the way you'd like to see it done, those things become problematic. And so you want to be sensitive to those sorts of things. So I believe that is it. That is it for today. So I want to thank everyone for being on here today. I left my name and number up here for a while, and you had Brian. So if you want to get a hold of us, call us. I'd really encourage those that were on today, and I saw 2 or 3 folks that at least I saw that logged in, that have been talking to me about setting up a 401k. Just call Brian. And if you didn't catch Brian's number, call me and I'll put you in touch with Brian. But that's your best strategy, is to talk to Brian and just let him understand the personality of your investment strategy, and so he can best serve you. So, hey, Brian, that's it for the year for us.
Sounds good. We'll get something going in the beginning of next year.
Absolutely. We'll be kicking off again in January, so be looking for that. We'll do this again. This webinar was recorded. I got to shut that off now that I think about it. This was recorded, so if you want to get a copy of the webinar, if you missed it, and I know some people did miss the part of it, so I'm looking at the numbers of people that are on now that were on a half an hour ago. And so for those of you that came in late, if you'd like to get a copy, just drop. As a matter of fact, don't drop me a line. I'm just going to send you a copy of the recording. So